What is going on? Hopefully I have fixed the resolution for my previous video. If not, it looks good on my end. If not though, let me know in the comments. But welcome to my channel. I am the covered call guy, and on this YouTube journey my goal is to create $120,000 in annual passive income using covered call ETFs. Right now my projected annual dividend slash options income is about $76,000 a year, 6.3k a month, 1.4k a week, and about $200 per day. All right, legal disclaimer before we start though. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I'm not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So always conduct your own due diligence and consult with a qualified, licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. I am only YouTube certified. Now with that out the way, today's video is going to be on the gamma risk and path dependency decay. I talk about gamma a lot, gamma this, gamma that, right, on all my videos. But let's break it down. This video is just talking about gamma risk and how it affects your portfolio, right? I'm going to be using TSPY and ISPY as the 0-day time expiration because they're the one with the most gamma risk in terms of this particular strategy, right? And I'm going to have SPYI just to use as a comparison, right? The monthly player here, right? And so the warning here is that this could be one of the reasons why your stocks might go to zero, right? These strategies, as much as it boosts you up to the top, it can drag you down, right? So buckle up. We are going into the math. So hopefully I don't bore you and put you to sleep for this video, okay? It's quite important, especially if you own TSPY and ISPY or any other 0-day time expiration stock or ETF. All right, so the gamma thesis is that it's not free money. It never was, right? For the most part, we talk about Gen 1, right? You know, I make jokes about it. It's, you know, our grandfather's covered call strategy, right? They're old, lame. Again, guys, if you're new, Gen 1 is a term I just made up, right? Gen 1, Gen 2, Gen 3, right? To the daily 0-day time expiration, which is more almost like gambling, right? In a way, you're gambling every single day, 9:30 a.m. to 4 p.m. Eastern time, right? This is the Gen 3 of the new strategy, right? I really do believe this ship has completely changed how I risk my money, right? My central thesis for this video is when I speed up the income, which is daily, I also speed up the risk, right? So what is negative convexity? I always say that convexity this, convexity that, right? It's just a fancy way of saying small upside, unlimited downside, right? When the market rips up, I'm capped. When it crashes, I fall with it. It's the worst of both worlds during volatility, right? The reality check you always have to keep to yourself and tell yourself faster options equal concentrated negative convexity. So just have that in your head and say, oh, okay, now it makes sense. This is what the covered call guy means when he says that. All right, we're going to meet the players. I said it. I'm just going to use these three. TSPY that uses 0-day time expiration. This is the sprinter here, right? Or at least I think they kind of act like the sprinter. They sell options that expire today. Maximum speed, maximum crash risk. ISPY, they also do daily, right? They're the jogger, right? They sell options for tomorrow, hold risk overnight. And then we got SPYI and QQI. They're the architecture, right? Uses monthly spreads, right? Slower income, but safer structure. Right? So I'm going to be breaking down why the sprinter TSPY is mathematically destined to lose in choppy markets, right? This is the lineup, right? So different time frames equal radical differences in risk. All right, gamma, the physics of acceleration. Forget the Greek letter for a second. Think of physics, right? When we think of gamma, we think of all this technical terms, right? You see the formulas, right? Basically, it just means delta equals velocity. That just means how fast I am moving, right? Directional exposure, right? How fast I'm moving in that direction, right? Gamma equals acceleration. How fast am I speeding up into a loss, right? That's the curvature risk. I'm going to say, for example, my portfolio gamma is 0 or under. That means I am short gamma, right? So it means as the market moves against me, my position gets worse at an accelerating rate, right? Physics 101 right here. Gamma is how fast my hedge breaks. The sell low, buy high trap. Being short gamma creates a specific mechanical problem for me. As the price rises, my position fights the rally. I effectively sell the exposure as the stock goes up. As price falls, my protection disappears. I effectively buy exposure as stocks crash, right? This is the opposite of buy low, sell high. You're doing the opposite here. I'm basically selling the potential for big wins in exchange for a small daily paycheck, right? That leads to the trap. The market fights my positioning in both directions. But wait, isn't this just volatility? I'm gonna say no, right? So crucially, if you understand, gamma is not fair, right? Fair is the vega, right? So vega equals fair. Sensitivity to expectations, right? Like, I think the market might crash. Gamma equals action, right? Sensitivity to actual price movement. The market is crashing, right? So a zero date time expiration strategy like TSPY doesn't care about fair. It cares about action. Even if the VIX is slow, a sudden price spike can destroy the trade. Are you guys understanding this? If not, just let me know in the comment section below. Hey, can you explain this part a little bit better? I'm trying to explain it as best as I can. This is how I understand it. So hopefully, maybe we'll get a different explanation from someone else in the comments. This is just how I understand it, right? We're not typically, us cover call investors, we're selling the fair, like I said in other videos, right? We sell the fair. For the most part, TSPY, not really. It's all about price action, right? So crucial distinction here is that, right, TSPY, I am betting on calm prices, not calm expectations, right? So the zero date time expiration singularity, math of the explosion. What do I mean by that? Why is TSPY so risky? Because options expire today, right? Today is almost zero. So look at the formula here. All that means, don't worry about it, just look at it, but don't have to digest it, dissect it. That just means as time moves, I'm losing out on money, but the risk increases. That's all it means. That's it. Just look at this. I put this little emojis here to make it easier for you guys. That's it. As time goes on, my premiums or whatever, the price drops, but my risk shoots up. Right? So what does this mean? Imagine driving a car towards a cliff. If the cliff is 3 days away, you have plenty of time to turn, right? Low risk. If the cliff is 5 minutes away, you have to turn the wheel violently to survive, right? High risk. Zero daytime expiration means the cliff is right in front of your face and you have to drift and you have to, you have to do some type of Tokyo drift here, right? Not all of us can do that. All right, so that leaves you in a danger zone. As time runs out, my margin for error vanishes. So that's why SPYI, QQI they dominate, because something can happen in the first 2 weeks of the month, and then they have another 2 weeks to adjust. They can literally be like, okay, this happened, I will adjust. Or the first 3 weeks of the month, is something crazy happens. They have 1 full week to adjust. That's why SPYI and QQI dominates. They have time to readjust their calculations, their strategy, right? So TSPY's binary reality is that because TSPY uses options that expire today, I face a coin flip every single day, right? So heads, I win. The market stay flat, I keep the premium, easy money. Tail, I lose. Market trends hard, shoots up 1.5%. I hit the cap instantly. I lose all upside for the day. Right, there's no waiting it out. At 4 p.m., the result is locked in forever. Right, so the coin flip here it's basically all or nothing by the closing bell. All right, path dependency. This is the silent killer, right? This is This is how I lose money even if the market goes nowhere. This is called the whipsaw mechanism, right? So day one, the rally plus 2%. I'm capped at 0.03. 0.3%, right? This is just an example here, right? I missed the gain, By day 2, it drops 2%, right? I take the full loss, I eat the pain. My net result here is the S&P is flat. I am down 1.5%. That is the silent kill, all right? I can lose money even if the market stays flat because there's no action. Remember, guys, action. This depends on action. If the market is flat, there is no action, you end up losing. All right, math of the whipsaw. For those who don't know what whipsaw is, just Google it and you'll understand, right? It's like a saw and you go back and forth, right? This whipsaw effect is actually a mathematical text known as volatility drag, right? So don't worry about this. This is just how it is. This is the formula. Don't worry about it. I just put it there for those who are interested and can want to Google it, put it in their Excel sheet. If you're good with that, go ahead. But in plain English, volatility acts like a tax on my return. Right? It's like Uncle Sam taxing every single profit you make every single day. The higher the volatility squared, the more return is drained from the fund. Because I cap my upside daily, I'm paying this tax every single day the market chops. The tax, volatility squared divided by 2 equals my pain. So if you're great with math, you can simply enter it and formula into Excel and you can calculate it that way. All right, return of capital, ROC, as decay, right? When this whipsaw occurs, the fund still has to pay me a dividend. Where does that cash come from? It could possibly come from my own principal, right? This would lead to a thing we call destructive ROC. They are selling shares of the underlying stock to pay me cash, right? This permanently shrinks the fund. The bad news, they are selling the furniture to pay the rent. You're going to come to an empty house, right? The death spiral scenario. Remember, I warned you that your stock might go to zero. Well, this is the scenario here. Again, of course, guys, let me just reiterate. This is a scenario, okay? Before you hammer me in the comments, oh, this is not going to happen. This is a what if. I like to put what ifs because why not, right? I got anxiety. I like to spread my anxiety to everyone else, including you guys, right? So the whole, if the NAV drops 50%, I need 100% gain just to break even. What is the latter? If my daily upside is capped at 0.5%, it would take about 200 perfect days in a row to recover. If I dig the hole too deep during a crash, my ladder, which is the capped daily return, is mathematically too short to ever get me out. This is the nightmare. If I fall too far, I can never climb back out. All right, let's talk about the gap risk, right? Naked versus hedge. What happens while I sleep? Because you're gonna have to sleep, and they're gonna have to wake up to do that daily 0-day expiration, right? So TSPY uses 0-day time expiration. We call this naked. That means when the closing bell expires at 4 p.m., I go home with zero protection, right? So let's just say it gaps down -2%. I capture 100% of the drop. If it gaps up 2%, I capture 100% of the gain. Versus hedge, like ISPY, right? 1-day time expiration. That's, quote unquote, the hedge. Sales calls expiring tomorrow. I can go home a little protected, a little bit. I can feel some type of insurance, right? If it gaps down -2%, short call gains value, cushioning me. If it gaps up 2%, I missed the move. I'm capped, right? So the overnight risk is that TSPY loves overnight pump. ISPY hates them. So what can you do? Technically, you could mash these two together and kind of play off one another, right? You take one side, I take the other. So you can kind of play around. You can kind of use it to hedge each other. It is a strategy I've seen people use. It might fit you, it might not. You might pick one over the other. That's also fine. It just depends on what your risk tolerance is for your portfolio and how you're going to use it to achieve your goals. Some people do both. Some people, that's fine too. It is essentially a different strategy. All right, the overnight scorecard, right? Again, guys, this is my guesstimate. This is what I've put together. I think what happened. Based on the strategy, so take it with a grain of salt, okay? The feature here is option tenure. TSPY expires today. ISPY expires tomorrow. Overnight delta, TSPY, it's about a 1.0, right? Is long equity. ISPY is about slightly underneath 1.0, right? It's hedged. If the market gaps up 2%, TSPY for participation. ISPY is capped and or you take a loss. If it gaps down 2%, TSPY takes the full loss, while ISPY is cushioned loss. The scorecard, pick your poison, right? You're going to have gap risk or capped risk. Or, again, people play both. You can pick both. There's nothing wrong with that either. Alright, the architectural control group, which, SPYI and QQI, I'm put them into play now, right? So is there a better way? I'm going to say SPYI and QQI tries to fix the math, not just the time frame, right? We have Convexity repair, which is call spreads. They buy long out of the money calls, right? If the market rockets up 5%, the long call kicks in. This uncaps the fund, allowing it to participate in the rally, right? Then we have the temporal dilution, which is it's just monthly. That's what they're basing off, right? That's the strategy. By writing monthly options, a 1% move today doesn't break the hedge, right? It gives the manager time to adjust. Remember, I talked about adjusting. They have a full month to, right? The alternative is that they fix the math, not just the time frame. So why do I put this here? Well, you can own monthly and have the 0-day time expirations to play, use it as a core satellite and play around your monthlies. Again, that is another strategy that people like to do. Right, and it's just the appendix, right? This is the profit formula here. I'm breaking it down to, how do I actually make money, right? It's a battle between income and acceleration, right? So, again, formula here. Again, in plain English, I collect the income daily. I pay a penalty based on my risk, multiplied by the price moved squared. You really don't know. You really just have to understand how not even a formula, because we have active managers doing this, but this is how it basically essentially works, right? So when you say, oh, it's going up, oh, it's because of this, oh man, it's going down, oh well, it's because of this. That's all you need to do. That's all you need to understand. Right? I always try to break it down. You have to know what you're buying here. Right, so the 0-day time expiration problem is that, for me at least, I think the 0-day time expiration strategy, right, my risk number is massive, right? Therefore, even a medium price move result in a squared penalty that instantly wipe out the income, right? The profit formula is just a small move squared is a big loss, right? So those, as much as it can increase because of its choppy or upwards, it can also be a flat or downwards, and you can lose it all. Right? When does this actually work? Well, I think, okay, this is another scenario. This is my guesstimate. In a market regime of grind up, low volatility, I say TSPY is very optimal, captures all premiums. SPYI does good, and that's all right, it's meh, whatever. Right? And the melt up, right? Fast rally. I'm gonna say TSPY failure, cap hits, you lose out. SPYI superior, spreads help. In a chop or volatile, right? High range, TSPY does have, I would say, critical failure here because of the whipsaw. I'm going to say SPYI could be mixed. It could be okay. It could be bad. I mean, it could be bad. It could be good. It could be a little bit of both. It could be right? And a V-shaped recovery. TSPY, again, I'm going to say failure here. It misses the rebound. I'm going to say for SPYI at least is superior. Absolutely. We've seen it happen. Just look back at the charts. It has happened. It has that amazing recovery. At least when it compared with these two. Okay, I'm not comparing it with anything else. I'm just comparing it with these two. Okay, all right, this is my cheat sheet here. I'm gonna say, at least for the strategy, TSPY needs a more calmer market versus SPYI can tolerate the chaos, which it has shown, by the way. Just so you guys know, it has shown that is much more resilient. All right, so my final verdict here, right? So, man, did I talk too much about the bad? Did I not talk about enough about the good? Was I a little bit biased? I hope the verdict here kind of make it seem that, look, it's not all bad, right? Because at the end of the day, gamma is the product. As long as you understand the product and you like the product, it's a good thing. Right? Investors in TSPY are not buying a yield instrument, right? I am selling intraday convexity, right? I am betting that the S&P realized movement between 9:30 a.m. and 4 p.m. will be statistically lower than what the option pricing model predicts. TSPY essentially is a precise instrument for low volatility, purest yield extraction, but the highest frugality, right? So, SPYI and QQI mitigate this gamma risk by distributing it across time, right? 30 days. Less efficient yield, but more robust total return, right? Right here, don't buy what you don't understand. If you don't understand it, right, don't touch it. Thanks for watching, guys. I hope I did not scare you out of TSPY or 0-day time expiration strategies, because again, as long as you understand what they're doing, just do your own due diligence. And if you got a knowledgeable understanding of it, and it works for your portfolio, it works for your lifestyle, and it works for your goal, go ahead. All right, hopefully this video wasn't all straight just carpet bombing at the TSPY and ISPY. This is not the video for it. I'm just trying to explain the gamma risk, all right, what could go wrong. So if you found this educational, creative, informative, you like it, you don't like it, give me a like, give me a comment, and help me subscribe to me. Even if you don't like my channel, still subscribe. Help my channel grow. I appreciate it. Thanks for watching, guys. Catch you guys in the next. Stay tuned.